Hello, everyone. Thank you for joining us today. My name is Marche. I'm the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however funny, true, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box today. The presenter will answer those queries during or after the webinar today as appropriate. I will add one caveat. If you have a question that we aren't able to get to, go ahead and leave your phone number in the chat box as well. We will make sure someone reaches out to you after today's event to address that query. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's guests. Erin Watkins is a Georgia native, a true Southern belle, but is now happy to call Colorado home after receiving her Bachelor's of Business Administration and Finance with an emphasis in risk management and insurance. Erin and her husband packed up everything and moved to Colorado, where her husband served in the Army. She is currently working on obtaining her MBA from Colorado State and has many hobbies ranging from skiing, climbing, photography, and playing with her animals. And Erin, Colorado, it's certainly a great place for those things. So go ahead and come up and mute, say hi so people can see you.
Hi, thank you so much for having me today. I'm excited to be able to moderate this webinar with you guys.
Excellent. And so Erin will be monitoring the chat. So if you have any questions, feel free to chat those in. Erin will address those.
Yes.
I'd love to introduce you to today's presenter. Dawn Beelan is a principal at Perkins & Company Accounting and is an expert in business transition and succession, consulting, and transaction advisory services. Dawn specializes in ownership transitions and business succession for successful business owners and affluent individuals. Since 1992, Dawn has successfully completed in excess of 300 business transition and succession plans for clients throughout the United States. He works closely with Perkins clients and staff to provide direction and consultation to design and implement advanced planning strategies. He's recognized by his clients and other advisors as a trusted, knowledgeable, organized, and creative leader in his field and community. And Dawn, we're so excited to have you again. And I will tell our attendees that we have a previous webinar that we will make sure in the email, I'll send you a link to that as well that Dawn has presented on. So we're excited to have you back, and I will go ahead and let you take it away.
Hello, everyone. Thank you for the opportunity. Appreciate this chance to share some insights that I hope that will be valuable to you. I've had the pleasure of working with Close-Ale Business, as Marche had alluded to, for over 25 years. And included in that process has been some external third-party sales. And over the last 5 years, I've increased that emphasis on what we call transaction advisory services, which is really a proactive way to position businesses and the business owner to maximize their value and increase the likelihood of a successful transition. So looking forward to this. During this discussion, I believe it's very beneficial for the participants to feel free to ask questions as we go through the materials. Either raise your hand, just interject as you see fit. The more interactive I believe that we can make this, discussion today, the more value that you're going to obtain through our discussion. So let me go ahead and go through the agenda. So in our agenda today, the first thing I'm going to talk about, and this is always fundamental to any planning process, is looking at the seller's objectives and expectations and looking at it in three different segments. What does it mean to the individual as a person? What's it mean to the business? Then what are the financial components in terms of business value, taxation considerations, deal structure. So we'll get into a lot of those underlying details. Secondly, we're going to talk about the M&A process and really helping to distinguish the difference between a broker and maybe an investment banker, and what are the steps and the approaches towards negotiating a deal that can lead to a successful transition. Next, we're going to talk about business value drivers, and I'm going to take probably a less than traditional approach in talking about what I've learned through my experience in terms of how we maximize enterprise value in alternate forms besides increasing revenues, maybe driving profitability or increasing cash flows. Those are the naturals, but I think there's a better way. Next, we're going to be talking about business valuation drivers and capital structure, and how the capital structure and deal structure really needs to be customized and curtailed to the business owner's individual situation in terms of their personal financial security requirements, their risk profile, and what it means in terms of the business ability to fulfill the deal structure as it's been, created. Then finally, in the event that there are outstanding questions, I'd like to have an opportunity to dive into your thoughts and your questions that may have arisen through the discussion today. First part I always like to start with is really dissecting the markets. There's a lot of, I think, misunderstanding, especially in the public sector, of what large companies represent in the overall marketplace. So what this slide shows, when you look at the bottom axis, we're looking at revenues. So it goes from a $5 million revenue company on the bottom left to over $1 billion revenue company on the bottom right. On the left-hand axis, just to give you an idea of what percentage of businesses in the marketplace really are represented by small companies. So companies that $5 million or less, believe it or not, there's approximately 5.4 million companies in the United States, which represents about 15% of our GDP. So the lion's share of companies in the marketplace are relatively small. And those companies, because of their size, their multiple of earnings, oftentimes adjusted earnings, is oftentimes in the range of 2 to 3. So just connecting the size of the revenues and profitability and cash flow to the valuation of the company. The middle market, which many investment banking firms focus on, which is a large population of organizations that service that segment, believe it or not, that middle market has about 300,000 companies, so a significant number of companies. They represent about 40% of the US GDP. But their valuations change dramatically because of what you call the accretive value related to an acquisition. So their earnings multiples might range from a low of 4 to high of 11 plus. And you look at that, compare and contrast to large companies, that represents only 2,000 companies in the United States that are over $1 billion. So it's a relatively small. They do have a large impact on the overall GDP of the U.S., about 45%. But you can see their multiples when you look at even the S&P 500. You've seen the earnings per share multiples at almost historical highs in the 17, 18, 19 range. So the multiples are very different for these large companies. So let's talk about some of the desired outcomes and expectations that a business owner should have when working with a experienced and seasoned mergers and acquisition advisor. Number one is to work through a process, and this may sound very elementary, but defining the seller's goals in terms of how much value they need to realize from the transaction, the timing of the realizing of that value, the structure of that, how it relates to their estate, how it relates to their key employees, and how it might relate to their family. So dissecting that in a fair amount of definition. Number two is really defining this deferred or this preferred transaction. So by example, is it a stock sale? Is it an asset sale? Is it a merger? Is it a carve off? There's all kinds of different results that can occur that are a function of also the business owner's long-term relationship with the business in terms of ongoing involvement, and then what it means in terms of the business ability, if it, depending on the buyer, the business ability to finance that transaction. So what are we trying to accomplish? Number three is assess the business valuation drivers, as we'll get into at a later slide, is identifying, as I alluded to at the intro, is that the business value is much larger than just a function of its revenues or its profitability, but looking at the areas of the business that really drive or impact risk. The reason why I talk about risk is purely a function of the multiple. And think of how a business multiple is ascertained. So for example, if the business risk profile based on what you call the build-up method, let's say that's a 20% rate of return based on the risk that's required, that would translate into a 5 multiple. So it's 1 divided by 0.2 is a 5. So the greater the risk, the lower the multiple, the lower the risk, the higher multiple. So I'll get into a live example that illustrates that. Next is to take a look at the business and estimate its transaction value and working oftentimes with other bankers or looking at comparable transactions to get an idea before going to the market. What is the potential enterprise value for this based on the different types of purchasers that are in the market? Financial purchasers maybe versus strategic purchasers. So it's important to understand what we're getting into. Next is also making sure that you have a very talented, experienced, and seasoned advisor team. Do you have a specific legal counsel that is an M&A attorney? Do you have tax and a CPA that has gone through transactions that understands deal structure? Do you have an investment advisor that can coach you on alternate means to maybe position the stock before the transaction? Do you have other key business advisors that are helping you to right size and maybe improve the quality of the business? So there's a whole team that should be incorporated into this process. Next is also to understand from the business owner standpoint what we're getting into. What does the sale process look like? So the due diligence process is going to be very invasive. They're going to be looking under the cracks for everything possible, the agreements, the historical customer relationships, liability considerations, registration, state licensing, insurance contracts, you name it. So it's a very thorough, involved process that the business owner should really take heed to. The next is really begin preparing the business owner for this future transaction. It's helping them to go through the process of understanding what their post-transaction life might look like. The saying I use with business owners is that we must know where we're going before we can get there. Because oftentimes what I see, even in the 11th hour, where the difficult negotiations become paramount, is the business owner has a tendency to want to withdraw because it wasn't what they originally thought the transaction was going to be. So there's a lot of mental coaching that should occur. So let's talk about from a pure sell side process. Of course, there's two sides to the equation. There's the buy side process, but I'm going to talk about the sell side. So this is really focused on preparing the business owner even one step further in terms of what they can expect through that process. So the first item is identifying the potential buyers. So before we even engage either an internal investment banker or an external investment banker, is decide or identify who are the prospective buyers Where are they located? What kind of businesses are they looking for? What kind of characteristics in the business are they seeking? And how large is this buying pool? Number two is preparing the marketing book. Based on the prospective buying pool, is prepare the marketing book that is going to appeal to those individuals. So what I've seen is a lot of customization occurs within the marketing book, sometimes referred as the offering memorandum. This memorandum is going to be very specific to the prospective buyers and the areas that they're looking to maybe augment their business. Maybe they're looking at supply chains. Maybe they're looking at distribution channels. Maybe they're looking at pure marketing growth. Maybe it's geographic expansion. Whatever those might be, it's important to understand from a potential buyer standpoint what is going to be the most accretive. And accretive just basically means additive value. Number three is the marketing process. I'll touch on this in just a moment, but do you take it to a broad market in a shotgun approach, or is it very narrow and focused? Number four is the negotiating the price and terms. Rarely is a business sold where the purchaser just writes a check and wishes the seller farewell. There's much more involved, and we'll talk a little bit about that in terms of negotiating price and terms, because the terms are as relevant and important in the overall process as the actual price itself, and oftentimes are going to be the drivers of whether or not the transaction is completed. Next item is dealing with structuring the transaction. Is this going to be an asset deal where it's desirable for the purchaser because now they get to restart their depreciation schedules? They want to avoid the liability associated with historical operations? Or is this going to be a stock deal related to the business owner that wants to minimize their tax impact? Or is it a combination? The letters of intent is oftentimes within the process of understanding that most letters of intent are non-binding. However, there will be binding components. So it's important to have competent legal counsel that's working with you to evaluate the letters of intent, making sure that you're not committing to something prematurely. Next is responding to the due diligence. Oftentimes through a competitive bidding environment, there'll be multiple letters of intent that are occurring, but then how do you respond to those individuals? And how do you prepare it through the due diligence phase? Oftentimes you've ever heard of a data room where there is going to be a repository for all the due diligence information. So what I have seen as what we would do as far as investment banking function is set up a data room. The information then is downloaded. So as prospective buyers are reviewing that information, we can tell exactly what information they're reviewing, how long they're reviewing it, and what's most relevant to them. So we can get an idea of really what their focus and concentration will be that could be used in the overall negotiating process. Next is definitive agreements. That typically takes the form of a sale and purchase agreement, sometimes referred to a PSA, and the other agreements that might have some conditions related to maybe holdbacks, or if it's an equity role where you transfer a portion of your business sale value into the acquiring company, there might be some earnouts. So those kind of things require a lot of attention. Especially one area that is critical is what you call your working capital, is making sure your working capital formulas are well defined, and that, because that is going to be very paramount at the point of closing, is what's your beginning working capital versus your ending working capital, and how is working capital defined. So, and then the final item is the closing process. Albeit that it's challenging, most of the heavy lifting has been completed in steps 1 through 8. So the closing process is the final, what you call true up. So towards the end of the process, we'll true up the value of the balance sheet, the income statement, et cetera, relative to the closing date. And that's where some adjustments are going to be made to reconcile and to finally true up the value relative to the purchase price and sale terms. So the closing process is also where most deals fail because they have not done their homework, and the letter of intent, the due diligence, or the definitive agreements steps were skipped, that become relevant in the final closing documents.
Hey, Don, we've got a couple questions coming in.
Okay.
So first question, what steps do you see that most sellers tend to overlook in this process?
Well, I think number one is even the letter of intent. They take it for granted that those terms are non-binding, so they don't put a lot of time and attention to those terms, and because that is really the beginning of the negotiations. And it's overlooked and not recognizing that it's important to line out the general fundamental terms and get agreement on those terms by virtue of the letter of intent, and not just skipping past that and thinking that it's arbitrary. So I think that's the number one.
Okay, thank you. One last one real quick. Do you think it's a good idea for someone when they're beginning this process to maybe get a third-party appraisal done?
It comes up a lot. My opinion, in fact, I'm dealing with one right now. So their first thought is, let's go out to a business valuation person and get that value. Well, the value came back at about $10 million. So we then looked at market comps and similar type transactions in this space. And we said, no, we think this is best case, probably $7 to $8 million. So the business owner paid probably $15,000 for this business valuation approach. And so I think it's going to be more time and cost efficient to reach out to a couple investment banking firms, and they will give you on a gratis basis more of a market assessment. Then you can compare and contrast those relative to your expectations. So my suggestion is don't waste the time to get a business valuation, because the methodology used for a business valuation is oftentimes very different than the market study that an investment banking firm can do.
Thank you.
So let's talk about what's happening in the marketplace. There's a lot of traditional buyers, strategic buyers, by example, or financial buyers, or even related buyers. Strategics typically demand the highest, to the seller, highest multiples, just because of the synergies and the overall economies of scale that are accomplished within strategic buyers. Financial buyers have actually, we've seen a transformation where there's been so much money flowing into either private equity or management buyouts, or even what you call these bolt-ons, and I can explain what that is. But financial buyers have been almost come to parity in terms of earnings multiples in the marketplace. And the reason is that financial buyers typically have a pool of capital that they need to deploy in a very specific time frame. And if they don't, they have to return that capital to their investors. So that's been a very interesting transformation, and that's actually persisted for about 5 years. And we're anticipating that, even speaking with other investment bankers, continuing for probably another 2 to 3 years because of the ultra low interest rate environment that we find ourselves. With private equity platforms, you see platform companies where they basically buy a certain type of companies and then they roll them up into a larger company and take them back to the market. Back to the market slide that I had earlier. As you graduate in size, you also graduate in earnings multiple and overall enterprise value relative to cash flows. Bolt-ons mean that you have an existing platform and you're going to bring on additional companies that can automatically benefit from that existing infrastructure. So it's very synergistic. You might have price earnings growth type sponsored, just regular PEG sponsored management buyouts. So you might have a professionally run organization that is going to be funded by private equity. And that even would serve the form of what's called a replacement owner, where the private equity comes in with their MBA team and uses the existing management team in maximizing their overall effectiveness. Of course, there's other what's called related buyers that might be co-shareholders, management, partner buyouts, or even family members. But more importantly, just on the next slide, this is more of a transformation that it's occurring in the marketplace. So we touched on, well, actually, this is actually a continuation, but I want to just hit some key points and the reason why strategics can actually pay more. One I've touched on is synergies, maybe some continuity between product and services, maybe reputation in the marketplace, et cetera. So they have alignment. So if you're looking at a strategic buyer, you'll have to look at how your company aligns with the strategic. The number one reason why strategic purchases fail is the fourth item here, is the lack of symmetry or, I guess, alignment with the values and culture. So I can't stress enough that if you're going through a transition, is to look at the values and culture of the potential purchaser and figure out if they do coincide or align. And if they don't, because oftentimes it's very impactful on the employees, the culture, the customers of the organization. Financial buyers are going to look at the business very, very differently. They're going to look at the quality of management because they're going to be depending on that manager to run and operate the company. They're very investment return related. I've seen financial buyers rate of return requirements go from mid-20s to low 30s. So where they want to have is their return based on free cash flows, the return on their investment over roughly a 5-year period. They want to receive about a 30% return on investment per year. So it is definitely a steep hurdle to I guess complete. A couple other components with a financial buyer is looking at the market and growth potential. They're going to look at the potential growth opportunities and what that long-term growth rate would look like. They're also going to look at, when we look halfway through this list, is the EBITDA margin. So your earnings before interest, taxes, depreciation, amortization, their margin. So oftentimes the financial buyer are going to look for at least a 10% EBITDA margin. Very important. They'll be looking at these tangibles and intangibles, maybe the competition in the environment, whether or not we have some higher risk factors such as customer concentration. Then finally, what is their future liquidity event? Financial buyers must have an exit plan when they go into it. Otherwise, they won't. Next is we're going to talk about, I'll look that up. This is where I was referencing, there are kind of an evolution in the marketplace. They're becoming much more dominant than they were even 5 years ago, is what I call the shades of private equity. So you have these private equity funds that emerge that become very large. And so they even will take the form of pure buyout funds. They'll even be sources of capital to fund growth. They'll help companies maybe recapitalize, take out some debt, take equity positions. You might have management funds that are predominantly just almost like investments into a variety of companies. Mezzanine is really referring to debt capital that doesn't require interest payments during the term of the debt, with a longer term expectation there will be a liquidity event. Mezz debt is oftentimes used for companies that need growth funding. You might have distressed capital for companies that are underperforming. VC capital, which is more so of emerging companies. You might have seed funds for maybe emergings or startup, and then also R&D funds that are predominantly funding research and development for the growth of a company. So you're seeing a lot of different varieties. So if you're considering a private equity transaction, which again, they're more prevalent than ever, then look at the nature of the private equity fund, why they do what they do and how they're capitalized and what their timelines are for those investments. The other two areas that have evolved and become very influential in the marketplace are family offices. Family offices are basically a large family business that have gone through a liquidity event that have funds that they need to deploy. And they're oftentimes patient. They're understanding of the dynamics within a closely held business. They are long-term perspective and thinking in the way that they run and operate the business. Short-term returns are not their primary objective. And they also will entertain and support family involvement. So family offices oftentimes are a great source in that marketplace is oftentimes connected to the investment banking world. So investment banks are establishing relationships with large family offices across the United States. And finally, independent sponsors. So these are typically individuals that have exited their business that might have capital to deploy, or might even be professionals that are able to enter into transactions. So the third item down, we have fundless sponsors. What that means is that they're able to buy a business with basically no capital, personal capital invested in the transaction. So it becomes creative in terms of how the deal is structured with a combination of debt, equity, maybe outside investments, deferred installment notes by the selling entity, and bringing professional expertise to the table. So fundless sponsors have emerged into being something fairly significant in the marketplace. So the point of all of these different sources of capital to fund a business, or to purchase a business rather, is to give you a sense that there is more than just the traditional strategic or typical financial buyers related to purchasing privately held businesses. Next, let's talk about just how businesses are taken to the market and how they might be negotiated. The first item is probably the most prevalent with larger businesses where the business owner has a predetermined value that they need to realize from the transaction. And they'll lead with that and say, well, I'll be interested in going to the market if I can generate $50 million from the sale of my business. And that's the driver. And that's almost like shopping technique, is talking with the prospective, maybe strategics in the marketplace and say, this is my threshold. Is this something that you're interested in exploring? The second item is used for the most part by investment bankers, where it's a very targeted and limited auction where they'll go through a process, a sorting process. Let's say we want to identify 50 prospective purchasers, go through a sorting process to maybe narrow that down to 20, go through management interviews, narrow that down to 5 to create this competitive bidding environment to drive terms, to drive price, to drive structure. And then that provides an opportunity to keep even the privacy of the business as is not to be publicly announced that this business is on the market. So limited auction is highly recommended for mid-sized to large-sized businesses. As compared to a smaller business, let's say those $4.5 million, $5 million and less businesses, they'll oftentimes be limited to using a business broker. So a business broker will traditionally create an offering memorandum and then put that out like in a shotgun approach to basically almost like a real estate agent out to a very broad market to business owners in all kinds of industries that might have an interest. And of course, those are done and marketed on a generic basis, so the business is not revealed. However, once you figure out the geographic location, the market size, the industry, oftentimes you can narrow it down and identify who that business is. So far more broad auctions are limited to small business, and discourage it is, if you can, go to more of a limited auction approach.
Hey, Don. So with the negotiation sales, what, I guess, topics do you see that they look at the most when negotiating? Is there specific things that they're going to look at more than others that would help get a higher price, or?
Yeah, starting initially, it's going to be size of the company. So they're going to look at total revenues. The key thing walking into that is what kind of growth have you experienced over the last 3 to 5 years? And if you've experienced growth, then you have to understand why. What's driving that growth, and is that sustainable going into the future? And what can be done to continue to perpetuate that growth going forward? So they're always looking for growth, and then next they're going to be looking for the internal infrastructure of the company. Tell me about your customer concentration. Tell me about your sales and marketing team. Tell me about your professional management. Tell me about your infrastructure. Tell me about your IT systems. Tell me about your supply chains. Tell me about your product diversification, those kind of things. So that's where the next step is really try to understand the business, because what the individual is trying to do is understand it, again, like I mentioned, risk profile. So those are the main things at the front end that the that the prospective purchaser is going to look at. So the mistake that I see made commonly in the marketplace is trying to apply a basic formula and say, what is my business worth? So of course, number one component is your benefit stream. What are the future cash flows and free cash flows? So adjusted for interest expense. Usually it's treated as a debt-free business with a depreciation added back. But what does that look like on a long-term basis in terms of benefits to the buyer? What kind of cash flows are they going to experience? What does it do to maybe support their margins, to grow their revenues? Is it a complementary service offering? Is it a different marketplace? Is it a sales channel? What have you? The second piece that they're looking at is what is the multiple? And that's where I touched on earlier, is how you calculate a multiple. You can use a generic number and say, well, my buddy that has his $10 million company at $3 million of EBITDA, well, you got a 5 multiple. That means that company's worth $15 million. Well, that's very, very dangerous because company A and company B are very different, which I'll touch on in just a moment. The third component obviously is multiplying your benefit stream times your earnings multiple to get an idea of what the company's value is. But really, it's an unlimited set of values because it's relatively easy to quantify the benefit stream depending on the overall growth rate assumptions and margins, but it's very difficult to use a ballpark multiple to apply towards the company value. So the overall benefit stream times its multiple will equate to the company's value, but you have to define both of those two drivers of that valuation formula. So I think this is an example to illustrate maybe how two companies could vary dramatically in value. So company A and company B both have about a 25-year operating history. They're both in a very niche product, so relatively narrow. They have annual revenues of 30 million. They have a 10% EBITDA margin, so $3 million in profitability. And then also their growth over the last period has been relatively small. But let's compare company A when we get into the due diligence process. So when we got into the due diligence process, we started asking some more involved questions. Tell me about the product development program. What's the condition of the equipment? So looking down the middle column, tell me about the management team, the strategic planning. Do you have a defined strategic plan? Are your information systems compatible with potential acquirers? What about your reporting? Is it GAAP? Do you have audited reviewed financial statements? Have you gone through a quality of earnings process? Do you have lean initiatives? So do you have quality improvement programs? Do you have quality measurements in place? How sustainable is this based on competition? And then finally, what are you growing to develop and expand your team's capabilities? So company A was basically in pretty rough shape. They didn't have the conditions old, management team is thin and weak. They have old and antiquated IT systems. The financial reporting has been somewhat unreliable. They have no quality programs in place. They're overall at risk to being long-term sustainable, and their training is not structured. So let's compare that to company B. So basically, everything I've described is in almost opposite. So it's a robust product development program, continue to invest into intellectual property. Their equipment's brand new and spanking clean. Their management team is highly experienced and credentialed. Their strategic planning is well-defined and followed and updated. Their information systems are state-of-the-art and integrated relative to the industry norms. Their financial reporting is highly disciplined. They've got 3 years of audited financial statements. They're doing accounting according to GAAP. We have a defined quality improvement program. They are leading in their marketplace by their sustainability, whether or not it be DEI initiatives or whether or not it be community support or just really being a figurehead in the marketplace. And then finally, have a well-defined training program. So the question is, would you value company A the same as company B? And I'd make a strong case that company B is extremely more valuable, even though earnings are exactly the same.
Don,
So
with that, real quick, when you look at company A and company B, we obviously see a very big difference. But we have a question that says, is there something or I guess a point that you would know when to start this process? Say you have company A, but you want to become company B. When do you think you should start doing those types of things? What would you recommend if you're at company A and want to be at company B?
Yeah, absolutely. Fantastic question. First and foremost is to have an external group, whether or not be an investment banker, maybe a multifaceted accounting firm, maybe it's a business consulting organization or combination thereof, complete an assessment. I have about a 200 item checklist that I provide business owners that we walk through. So go through the assessment and then figure out where your greatest return on investment is going to be so you can begin to work on each of these items. But you got to figure out which one is going to be the most additive in terms of its value. So that's where, by example, I work with a large accounting firm that has probably 5,000 business owner clients. So our target is to get in front of them at least 5 years before we take this to market, and maybe as even late as 3 years, and giving us adequate time to address many of these issues. So yeah, very helpful. So let's talk about some of the external value drivers and really what is going to increase the value for your exit. So starting off is first, and this is a little bit repetitive, but I wanted to continue to focus on these items because it's important to dissect your business into these components. So there are, when you look at there's going to be 12 elements that you want to take into consideration. So I break this down by tiers. The first tier is the top level, size of the company, number of locations, what they're spending in R&D, and then the management structure. So you want to make sure that those are well established and that you have some diversification there. Then you look at your sales force, what kind of revenue growth rate you're experiencing, maybe your employee mix. Do you have the right people in the right seats? Back to the good to great concept. And also have you diversified your customer base? The natural tendency, and this is something that I think is relatively apparent, but business owners have a tendency to maximize value with existing customers if they have strong relationships. But that is their Achilles heel long term. So it's really important to, based on product line, to try to diversify your customer base both geographically, but also company-wide. Then look at your vendor relationships. Also geographic coverage. Are you concentrated in a particular area of the United States that is not going through a very good economic period? Do you have, in terms of maybe operating systems, do you have a well-defined organizational structure? Do you have inventory control systems? Do you have a good costing system? Those things will really come into play dealing with one where the inventory control was all over the board and the volatility created all kinds of questions to the acquirer. We had questions about the quality of the inventory. We had some obsolescence issues. So it becomes very important to look at those various tracking systems. And of course, believe it or not, last but not least is margins. Everybody focuses on margins, where that's something that if you connect and correct and improve these various areas, the margins will follow. One thing I bring in is the emotional component. So when you look at the components or looking at your business, there's basically 4 types of individuals that you might encounter as business owners, or you might be business owners that have particular dominant characteristics. So the first one, which is common, a type A type personality, is dominant. They're very decisive. They are good at providing direction, and they are very results driven. As compared to, and then that dominant person, they're going to focus on the 2 elements directly relating to the pie chart. They're going to be focused on planning and leadership. So when you look at their company, their planning and leadership is probably very strong. So when you look at that compared to the next personality style is an influencer. They're individuals, they're very people-oriented, they're optimistic, they're visionary, they're fun, they're social. So when you look at their company is going to be strong in sales and marketing, but they might be lacking in these other things. Then the third type that we would look at is the business owner more of a supporter? Are they patient? Are they consistent? Are they more systematic? Well, if they are, then their operational components of the business are strong, their people are strong, but they're lacking in probably some of these other areas. Then the final component is dealing with an individual that is more compliant. So they're very analytical, they're very accurate, they're logical, they're somewhat adverse to risk, they're not adventurous, they're not creative. So their company is going to be very compliant on the legal and the financial aspects, maybe the operational aspects, but they won't be thriving in the areas of sales, marketing, or leadership. So this is all important just from the standpoint that if you are a business owner, is to make sure that you focus on what potentially could be your blind spots in working with your team to make sure that you're incorporating all the elements from planning to people, from finance to sales. So that is then summarized by these two parts. So the dominant on the right-hand side, dominant influencer is very good at the big picture. They're fast in decisions. They're less detailed, but very verbal as compared to the compliant supporter type individuals. They're slow to the process. They're more detailed. There are more questions. They're more inquisitive, and they're more reserved. So this gives you a sense from your standpoint as a business owner or even as an advisor is to understand and even think more about who you're working with and how best to work with them based on their dominant personality styles. So let's bring this into a more of an analysis. Let this pop up. And in the interest of time, I'll expedite this process, but I just want to pull together these final components when you're breaking down and evaluating your company and positioning it for sale. This is more of a summary. So you have the planning elements, what's happening with strategic, your target market, barriers to entry, product development, leadership, making sure you have a defined and well-established board of directors and maybe board of advisors. You have the overall organizational structure. You have a defined corporate culture, and that you also have a succession plan in terms of your leadership succession. So what I see, though, with leadership is that these teams don't take all the structure, don't take the time to create the structure necessary, because that's very impactful as far as it relates to the type of buyer. In most large corporations, when they buy an existing business, they don't want to disrupt the existing business. They want to maintain their secret sauce. So having these elements in place is going to make this company more desirable. Also then, some obvious things in terms of sales, what's your region, your sales team, overall sales strategy, do you have performance metrics, maybe different levels of sales activities necessary to generate the required number of new clients. And then marketing, do you have a defined marketing team and what's that look like? Because through the due diligence, the prospective purchaser will tell me what your marketing strategy is. Give me a sense what your marketing materials look like. Let me look at your branding. Let me look at your overall positioning in the marketplace. There's a couple other elements that we would take into consideration. Of course, people, operations, which we've touched on, finance, and then finally legal. So I'll touch on legal just momentarily because oftentimes by M&A firms, the acquirer has a good legal team and they're going to look at any sort of future liability exposure. Have you had any litigation? Are there any pending claims? Tell me about the intellectual property, maybe the timing related to any sort of copyrights or patents. How long do they exist? What are the contracts? Are your agreements with your customers contractual? Are they yearly? Are they non-contractual? Give you an idea of predictability of revenues. Have you done your appropriate filings, your UCC filings, maybe your state registration? I had another client out of out of Ohio that we found out the registration with the state was not complete, and we had to get that completed because it was a problem from the acquirer standpoint. Do you have the various product licenses, or do you have complete disclosures about any sort of liabilities or service offerings? So there's a lot on the legal side. That's why you want to get a good, highly experienced lawyer that is skilled at M&A transactions.
What's the look back period for that? How far do they go back?
Yeah, that's also a great question. It depends on the type of company. Some of the lookbacks are almost infinite because there might be a tail on the product liability that could go back as long as the products have been sold. So there, you might have sometimes to limit that liability exposure. You might buy basically kind of like an E&O insurance or another insurance that gives protection to the acquirer so that in the event that they find something, they can tap into that. So the seller would maybe buy this insurance in advance of the completing the deal to give assurance that if the buyer finds something who has a tail or a liability, that they have coverage. So but usually it's pretty open-ended. So this is a financial illustration that I think pulls the discussion to a head and illustrates what can happen by risk reduction and the benefits of focusing on the items we've just discussed as compared to just growing sales or growing margins. So on the left-hand side, we look at the base case. So this business does about $15 million in revenue, again, has a 10% EBITDA margin. So it makes about $1.5 million in free cash flow. Long-term growth rate is only at 3%. So the value of the company is about $7.5 million. So terminal value is just a discounted cash flow of the future earnings. And then the company-specific risk, because of its current form, when we looked at it, what you call is the build-up method is what is the company-specific risk. So it's a function of all the infrastructure, the systems, et cetera, of the company. And then you get what you call weighted average cost of capital. The weighted average cost of capital is what you use for a discount rate. So if you have a weighted average cost of capital, call it 24%, 1 divided by 24% results about a 4.6 times earnings multiple. So that's a relatively good multiple based on a company this size. So if we then focus our energies towards reducing risk, all the financial metrics remain the same, but the company risk on the second to the last line drops from 14.5 to 6. So that earnings multiple that goes from 4.6 to well over 6 because we reduced the weighted average cost of capital, the discount rate. So by reducing the risk, that is going to be the greatest rate of return of your investment by focusing on risk reduction and preparing the business as opposed to when you compare sales growth. To get the same result of a $13 million enterprise value based on the terminal value, we'd have to more than double revenues, or we would also have to increase our margins. We'd have to double our operating margins to get to the same value related to reducing the company's specific risk. So of course, the best strategy is a combination thereof. Focus on infrastructure, company organizational structure, and go through the due diligence on the front end, and that will result in both increased revenues, increased margins, and reduced risk. And that's how we maximize value in this case, up to about $19 million from the starting point of $7.5 million. So in summary, let me give you the items that I think would be takeaways from our discussion today. Number one, I think it's extremely important to create a written and well-defined set of objectives and requirements. Have those developed and available when you then begin to interview investment bankers or brokers to get an idea of what your desired outcomes are going to be. Number two is understand the sales process. Today, hopefully, was a helpful beginning in understanding what's involved in this process and what you could experience as you go through this process. Number 3 is know your buyer and their goals. Why would they want to own your company and what are they trying to achieve? That is going to be the major driver in the overall structure of the transaction. Number 4, as we touched on, reduce business risk. That is the most efficient way to drive value. And next is to look at capital structure. And capital structure means, is it going to be debt that is used to purchase my company? Are they writing a check? Is it a seller note? Are they going to lever the company and maybe take external debt, like a leverage buyout, by example? All of those different capital structures will drive enterprise value because they impact future cash flows. So it's important to understand based on buying type. So that's what we have today. I hope this was informative and maybe even stimulated any additional questions. So I'm hoping if there's any questions outstanding.
Yes, a couple, actually. You said that there are a lot of deals that fall apart at the closing. What are some of the most common reasons that those actually fall apart?
Number 1, lack of proper preparation. I had one, by example, that we were at the 11th and a half hour and we went up to the true-up period with the financial statements, and there's what you called an accrued warranty. So the business owner said, oh, no, we don't. The accrued warranty of $20 million, we've never had that experience. So it really is more like about $10 million. And the buyer said, well, wait a second, this is the financials you presented. So we couldn't come to terms and we had to negotiate hard to make this thing close. So because the business owner didn't go through the preliminary due diligence and have more of a quality of earnings or have an outside third-party review of the financial statements, created all kinds of problems. Number 2 is the due diligence I had where we started to interview the prospective seller. We found out they had an unfunded pension liability of well over $10 million. The enterprise value was like 8. So because of that, nobody had looked at and said, okay, you're part of a union. Do you have a pension? And is that liability funded? So those are 2 great examples that came up that if you don't do your diligence, will come up and bear their ugly head through the due diligence process or at closing. The final one is where the purchaser decides based on their process that they started, let's say by example, that it was a $30 million enterprise value. Through the due diligence, they had identified some issues that they're not happy about. So what you find is that beginning of the process, the transaction value does nothing but go down. So the value in this particular case dropped by about $5 million. And then the business owner said, oh, no, I'm thinking this is $30 million and I can't take this. So it becomes principal. So that's where defining the objectives on the front end is so critical that we don't come to the 11th hour and not close a deal based on principle. So there's a couple examples.
Yeah, it's kind of that leave no stone unturned kind of thing.
Absolutely.
Yeah. And then one last one. So it kind of plays off of that. But what if a business doesn't have the market value that the business owner wants to realize? What do you do at that point?
Well, you'd probably consider obviously waiting. If the growth is not there, then you might consider maybe it's a merger. So trying to find some sort of synergistic connection with another company that you might be able to combine growth would be much better. So you might consider outside equity financing, maybe some back to the venture capital that would, an impetus of equity or debt into the business to fuel growth. A lot of businesses are very capital constrained. Maybe it's partnering with a professional, maybe it's private equity that has expertise in your space where they take an equity interest, but they're going to provide some more expertise in terms of sales and marketing or operational efficiencies or technology or intellectual property, those kind of things. So all of those are available. Or alternatively, finally, is the individual might have to just adjust their expectations and hold on to the business and just try to maximize its value, but maybe you sell it internally and maintain a cash flow and a salary position and continue to generate income, both in salary and sale proceeds over an extended period of time.
Well, that's about all we have time to do. I want to thank Don and Aaron for being here and the organizations that have made this webinar possible. Those of you who are on the call today, look to your email for a replay of this event, and you're welcome to share that replay with friends, family, and colleagues. Here at Advice Chaser, we're all about helping you find a financial advisor who's a good fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com, clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for being here, and we will see you at another webinar soon. Goodbye, everyone.
Well,
Thank
appreciate
you.
it.